Are you tired of struggling to fulfill your dream of becoming a millionaire and want to take control of your financial future? Look no further than the advice of one of the greatest investors of all time, the Oracle of Omaha himself, none other than Warren Buffett. So sit back, take notes, and get ready to become a millionaire. Rule number 1. Be fearful when others are greedy, and be greedy when others are fearful. When it comes to navigating the stock market, there are few voices as wise and experienced as that of Warren Buffett. Buffett, who has built a reputation as one of the most successful investors of all time, has long advocated for a strategy of calm and considered decision-making during times of market panic. Buffett's advice is simple but effective. Be fearful when others are greedy, and be greedy when others are fearful. In practical terms, this means taking advantage of opportunities to buy strong companies at discounted prices during periods of market downturn. By avoiding highly leveraged or weakly competitive companies and focusing on those with a strong track record and promising prospects, investors can position themselves for success in the long term. Of course, as Buffett acknowledges, timing can be a challenge. It may be necessary or to appear unimaginative or even foolish in the short term as other investors rush to take advantage of what seems like a lucrative opportunity. But by maintaining a long-term perspective and focusing on the fundamentals rather than being swayed by the influence of market sentiment, investors can position themselves for success over time. This approach has been proven time and time again. In the years following the 2008 financial crisis, for example, the S&P 500 saw a remarkable 130% increase, while companies like Apple and Amazon reached trillion-dollar valuations. By remaining level-headed and focused on the long term, investors who followed Buffett's advice were able to take advantage of these opportunities and reap the rewards. At the heart of Buffett's strategy is a belief in the enduring value of innovative American businesses. Despite the challenges posed by economic crises and market volatility, Buffett maintains that strong companies with promising futures will continue to grow and thrive over time. By focusing on these fundamentals and avoiding the hype and panic of the market, investors can position themselves for success even in challenging times. So, tell us down in the comments, do you know now when to be greedy and when not to be greedy? Rule number 2, when you buy a stock, plan to hold it forever. When it comes to investing, patience is truly a virtue. Warren Buffett has long espoused the benefits of holding on to high-quality investments for the long term. He advises investors to only consider owning a stock if they are willing to hold on to it for at least 10 years. In fact, Buffett himself has held on to some of his investments for decades, recognizing that it can be difficult to find truly exceptional businesses with a bright long-term future. The benefits of long-term investing are clear. High-quality businesses tend to earn high returns and increase in value over time. As Buffett himself said, time is the friend of the wonderful business. By holding on to investments for the long term, investors can benefit from the power of compounding returns and enjoy steady, reliable growth over time. But it's not just about finding the right businesses to invest in. The act of trading stocks too frequently can also be detrimental to your investment returns. Taxes and behavioral biases can lead to ill-timed trades, eating away at your profits. In fact, studies have shown that frequent trading tends to result in lower investment returns over time. Instead, it's best to carefully consider your investments and adopt a buy right and sit tight mentality. By investing in high-quality businesses with a bright long-term future and then holding on to these investments for the long term, investors can maximize their returns and minimize their risk. As Buffett put it, the stock market is designed to transfer money from the active to the patient. So if you're looking to build long-term wealth through the stock market, it's important to adopt a patient long-term perspective. Rule number 3, never compromise on business quality. One of the biggest mistakes that investors make is jumping on seemingly good investment opportunities without fully understanding the risks involved. This is especially true when it comes to complicated businesses or industries that are difficult to comprehend. It's easy to get swept up in the excitement of a new opportunity, but it's important to take a step back and evaluate the situation before committing any capital. Warren Buffett learned this lesson the hard way through his own experience with cigar butt investments that looked cheap at first but turned out to be traps that led to low returns and eroded the value of his initial investment over time. He realized that it's far better to focus on buying high-quality companies with strong growth potential rather than mediocre opportunities that may seem attractive at first glance. To do this, Buffett advises investors to look for companies with strong returns on invested capital and economic moats, which are indicators of a business's quality and ability to compound earnings over time. By eventually evaluating those factors and investing in high-quality companies, investors can increase their chances of success and avoid the pitfalls of mediocre opportunities. It's also important to consider the overall business quality before making any investment decisions, rather than being swayed by attractive dividends or cheap valuations. Buffett's famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," underscores the importance of focusing on long-term business quality over short-term gains. Rule number 4, invest in what you know and nothing more. When it comes to investing, it can be easy to get swept up in the excitement of complex industries and cutting-edge technologies. However, as Warren Buffett has pointed out, this can be a recipe for disaster. In order to make smart investment decisions, it's important to approach these types of investments with caution and a healthy dose of skepticism. As Buffett famously said, "Never invest in a business you cannot understand." This is sound advice for any investor, regardless of their level of experience or expertise. While it may be tempting to try and forecast the success of a biotech company's drug pipeline or predict the next major fashion trend, these types of complex issues are often unforecastable and can materially affect a company's earnings. Peter Lynch, another successful investor, takes this idea even further, advising investors to only invest in ideas that can be illustrated with a crayon. This emphasizes the importance of simplicity in investing and underscores the fact that the most successful investments are often the easiest to understand. By focusing on companies and industries that are easy to understand, investors can increase their chances of success and avoid unnecessary risk. This doesn't mean that investors should shy away from innovative technologies or complex industries altogether, but rather that they should approach these types of investments with caution and careful analysis. Ultimately, the key to successful investing is to remain focused on the fundamentals and to avoid getting swept up in hype or excitement. By investing in businesses that are well positioned for long-term growth and that have a proven track record of success, investors can increase their chances of success over the long term. Tell us down in the comments if you used to think that a business needs to be complex and innovative for it to be successful. Rule number 5, most news is noise, not news. Are you tired of feeling overwhelmed by the constant flood of financial news and information? In today's fast-paced world, it can be difficult to navigate the endless stream of financial news and information. With constant updates and headlines, it's easy to get caught up in the moment and make impulsive investment decisions. However, as Warren Buffett has emphasized, it's important to remain level-headed and focused on the long term. At its core, successful investing requires a disciplined approach that's based on a few key principles. These include investing in high-quality companies with sustainable competitive advantages, being patient and holding on to these investments for the long haul, and avoiding complex businesses that are difficult to understand. Additionally, it's important to avoid the noise and distractions that can cloud our judgment and lead to irrational decisions. By adopting these principles and ignoring the constant noise of financial news, we can become more successful and confident investors. We can focus on the things that truly matter, like identifying quality businesses that are poised for long-term growth and success. At the end of the day, investing is about more than just making money. It's about building wealth and securing a brighter financial future for ourselves and our families. By following the timeless advice of Warren Buffett and other successful investors, we can achieve these goals and create a better tomorrow for ourselves and those around us. So, let's take a step back, cut through the noise, and focus on what really matters. The rewards will be well worth the effort. Rule number 6, practice financial discipline. Are you dreaming of becoming a successful entrepreneur and striking it rich with the next big idea? While the allure of entrepreneurship is strong, the reality is that financial success requires discipline and prioritization. Putting your own financial security first by practicing financial discipline is the key to long-term stability. This approach may not be as exciting as chasing risky investments or luxuries, but it's more likely to lead to financial success. This approach may not be as exciting as pouring everything you have into a new business or high-risk investment, but it's far more likely to lead to long-term financial stability. Of course, financial discipline isn't just for entrepreneurs. Anyone can benefit from taking a more measured approach to their finances, regardless of their income or profession. By calculating your retirement needs and prioritizing savings over spending, you can ensure that you're building a solid foundation for your future. And it's never too early to start. Even teenagers can benefit from learning the value of financial discipline and starting their own retirement funds. By starting small and consistently putting away a portion of their earnings, they can lay the groundwork for a financially secure future. Ultimately, the key to financial success is to be mindful of your spending habits and to prioritize your own financial security. By putting a portion of your funds away first and practicing financial discipline, you can ensure that you're building a strong financial foundation that will serve you well in the years to come. Thank you for watching. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more informative content. Don't forget to leave a comment below and let us know which rule resonated with you the most, or share any additional tips you have for building wealth.